From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, December 10th. This is Tony Fratto at Hamilton Place Strategies. John Fagan, Brendan Walsh from Markets Policy Partners with us. It's a big CPI day today, guys. I think it was probably it almost had a jobs day feel to it with the anticipation for this number. I think probably as closely watched a CPI number as I can remember, but people looking for it to at least hit the market expectations number of 6.7%, which would make it the fastest inflation in 40 years since the malaise days of the early 80s. And the surprising thing, I think, is that the number came in pretty much spot on as expected, and market seems to like that. I think not being surprised is a really good thing, don't you think?
Yeah, I'm a little interested in the market reaction. I both markets, but equity is taking it well. But what do you think, John?
Yeah, I mean, it's pretty clear when you see when you see something like this, and the number is essentially right on the money, maybe a little bit hotter than expectations, and the market rallies and the bond market is placid. It's pretty consistent with the assumption that everybody was bracing for a really awful number. And the consensus expectations that economists put forward were being marked up mentally, so to speak, by all the traders on the street, and everybody was in a defensive crouch. And when this kind of number comes and doesn't necessarily surprise all that significantly on the upside, there's a sense of relief. And really, that's, I think, what we're seeing in markets. We saw S&P 500 futures jump. The bond market really didn't do much of anything. Futures markets didn't significantly change the outlook for anticipated Fed rate action next year and so forth. So about as, everybody would have liked a downside surprise. That would have probably had an even bigger reaction. But this is, good enough for now.
Yeah, and also this measurement was taken before oil prices and gas prices at the pump started to roll over. So
really good point.
People are factoring that in for next month's for the December CPI print.
Yeah, the headline is really about goods. The big differential is the goods and energy inflation components. Those are not everything's up a little bit, but those are the big swing factor since last year. And certainly when you look at energy prices, the market-based gauges of inflation expectations, tips, break-evens, 5s and 10s are what people usually look at there. Those are down pretty significantly from the mid-November highs, and those track oil prices. Oil prices at one point were down like 20% off the highs. And so, they've bounced back a little bit here, but, it's the Fed. The Fed kind of turned hawkish, and a lot of traders will say, you turned hawkish a week after the peak of inflation concerns. But it's timing's tough, and there's still a lot of there are a lot of decisions still to be made, and a lot of uncertainty around.
The other interesting part of this, you can break it down by the components that went up or down the most, and the ones that have been really up a lot recently, like our foods and especially used cars and trucks, new cars and trucks, and then also fuel. Before, we had a lot of components that were up like 10, 15% on a monthly basis. This month, the highest contributors were in the 1 to 2 to 3% range, which is much more normal. So I think that is a good sign that the things that were so out of whack, especially because of supply constraints, are moderating now. The one issue that the Fed will have going forward is the shelter component, which that includes, your house or your rental. That is accelerating, and we do it a little quirky way. So we don't measure it how much your house is worth. We measure it how much you could rent your house for. So what happened was, we're all aware, everyone moved to Montana, and the price of Manhattan properties plummeted on the rental side. Well, people are returning to the cities, pretty quickly, and especially Manhattan rental prices are spiking. So that is starting to come into the CPI. For the CPI, it's a big issue, especially core CPI. It's 40% of the core CPI. The PCE actually uses the same measurement from the BLS, but they weight it less. So it's about 20%. So, well, that's not like having a used car price be up 20%.
Yeah.
It is a sticky measurement that if you're so this month, shelter was a 0.5. If you just kind of had a normal distribution of, if you went back to what prices were like in 2018, say, and you had a shelter component of 0.5, you're looking at 3% core inflation, because that is such a large component of it. So while it's not something to freak out about, like we're going to stay here at 7% CPI, it is a sticky component that will make it harder for the Fed to come down to its preferred range.
And now the transitory has been junked by the transitory moniker characterization.
And add a Capitol Hill testimony.
Yeah, it was a strange venue to spring it on everybody, particularly right after. It was so close on the heels of the November meeting. And I think that there's the world will look a lot different when the CPI headline numbers peak out and start
with
to come
the
down.
year-over-year base effects roll off. Exactly.
If you look at any statistical metric of expectations of CPI coming forward, like they're coming down, and it's going to be really hard to have to generate these kind of figures go on a going forward basis, just on the base effect alone. The Fed's at the last Fed meeting, when we got the projections, they were still coming around like 2.5% inflation in 2022. They're very likely to mark that up, but at the same time, the Fed doesn't necessarily have to stick the landing like by next June. It doesn't have to be like at 2.5%. As long as it's coming in the direction that they want it to go, and they can credibly draw a dotted line to a 2.5%, a 2% target over the coming year, then the world's going to look a whole lot different when that happens, I think. And
I think you're exactly right, John. The trajectory, if I don't know if this is I don't know if this is the peak, and we'll see what December looks like. There are really good reasons to think that, just anecdotally, that you could see, you could make the case that this is a peak, notwithstanding what's happening with shelter right now. But supply chain, fiscal, monetary balance, household balance sheets. There's there are a lot of reasons why you can imagine it. Oil, as you noted, a lot of reasons why you can see that. If that trajectory is going down into 2022, doesn't, like you said, doesn't have to get down to the 2.5% inflation target. If we're talking about, we start seeing 5, 4, 3. Everyone's going to stop talking about inflation. You're not going to see this. And
that's going to be interesting, because inflation's become such a political hot potato lately, where the rest of the economy, this isn't a political say. I'm just citing data. Like the fourth quarter GDP is tracking at 9-10%. We're creating hundreds of thousands of jobs. The unemployment claims, that's a real number. That's a check that goes out. It was like an all-time low last week, but the Biden administration is not getting any credit for that, because for the first time in 35 years, we're experiencing a little inflation, and people don't like it.
I agree. I have a quoted in Politico today. It's essentially that. It's like, essentially my message is stop talking about, for you guys, stop saying that if you want to make this work, keep doing what you're doing, which is saying that, the oil companies are gouging you and big businesses gouging you, and you're not going to defeat inflation that way. But you have this really good economy out here to talk about. Like, there are a lot of really good things to talk about in the economy.
Yeah, talk about it.
I mean, you got low interest rates, you've got healthy balance sheets, you've got job creation, you've got wages increasing. Like, there's a lot of workers are in the highest demand since the 2000s. This is like you have a pretty good story to.
No, I agree.
I
think this would be happening no matter who was in charge, but you're in charge. So try to take some credit for it.
Yeah. It's absolutely what they should be talking about, but we'll see. I mean, every time they go out and sort of overreact on this stuff on, talking about inflation.
Yeah, I agree.
It puts more people talking about inflation.
Right. And then you can't hide the fact that inflation is at, 6-7%.
Well, linguistics aside, it is that no one's happy with 6.7%.
Right.
But how you talk about it, it matters. But no one's happy with that number. It's not like even though the market reaction was positive, I think because of that it didn't surprise, overshoot, and I think that's really important. Where it's going to be really fascinating these next couple months to just see where the data come in.
Yeah, but also just how much the world has changed. So the last time we had an inflation print this high, was the mid 80s, where
82, right?
10-year was at 13.8%. So now the 10 years at 1.5%.
This is not Malaise. This is not malaise.
Yeah, it's right. And right? Volcker isn't the Fed chair. But we did. Yeah. I mean, we talked about it at the last Macrocast, but when Powell sort of channeled his inner Volcker a little bit in his committee and his testimony in front of Congress, it'll be next week's Fed meeting is going to be really pivotal. And there's sort of the question is really how far is the Fed going to go in terms of pivoting toward inflation fighting? And this is, the reality that we've seen over the last couple of weeks is that the market amplifies everything, right? And as soon as the Fed still has, and maybe this is a legacy of Tall Paul, way past through the decades, the Fed is very credible on fighting inflation. If Fed Chair Powell and company came out and said we are going to battle inflation back, you would have a disinflationary, deflationary.
I know, but you're the communication guy. We've labeled it as fighting inflation. There's only one way we fight inflation. We raise rates.
That's true.
So, the voter might want you to fight inflation. When he finds out how you do it, he's not going to be particularly happy about it.
In normal textbook times, that's what you raise rates, but they don't have to raise rates because they can taper.
You're right. We
did asset purchases and eventually unwind. So they're different things they can. Different tools.
Either way, you raise the level of
absolutely.
borrowing.
Yeah, no, absolutely. I want to write the next FOMC. I think we could write it right now, right? I mean, it's going to be signs of, here are the reasons why it can come off, and just like sprinkle in some continued vigilance, and it's going to be the continued vigilance.
Yep.
FOMC statement.
Yeah, it'll be interesting to see. I mean, they've basically now conditioned the market to expect a doubling of the pace of the taper of quantitative easing, the taper pace that they announced last month, and so that's a pretty quick pirouette into a more hawkish posture. But this will be contextualized by the communications, contextualized by all of the updated projections and so forth. It is really going to be a pivotal meeting. And to the extent that they can get the balance right, clearly the market has an unstable equilibrium between inflation concerns and growth concerns, especially with Omicron coming around and China slowing down, and you name it. The yield curve is as flat as it's been all year. The growth sensitive, we take the Treasury yield curve very seriously, and it is telling you, that the Fed is kind of in a challenging place in battling inflation when growth is still a question mark as it is right now. So, at least into 2022, obviously this quarter is strong. So it's a delicate balance, and we'll see if they can walk the line. You don't want to spook the markets, and because you could tip very quickly into a disinflationary and find yourself doing what the Bank of England has done, which is reverse themselves again and again, oversteer into these curves. They've got a meeting next week too, and they're being pilloried by market participants for their vacillations in communication.
Yeah, I think they put themselves in a terrible place over there. But I mean, how you engineer these big moves. They are. But by the way, this sort of debate over whether monetary policy is hydraulics or communications and expectations. Matt Iglesias in his slow boring Substack newsletter today has a really good, super exciting discussion of this very issue. He does a nice job with it, although you could pick at it, but he does a really nice job with it. But that communications function is really, really important, and because you do set expectations for the market, and you go back to the time when the Fed was essentially on this multi-year quarter point, with 17 straight quarter point increases. That I felt at the time, but certainly in retrospect, seemed like just devoid of, analytical rigor, right? I mean, it was just sort of on cruise control of rate hikes. And we were actually in a dynamic economy that should have had some dynamic response from the FOMC at that time. So we'll see how they do it. It's a tough one. Let's get a break and come back and take a little look around the rest of the world. You're listening to the Macrocast.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The Civic Science Economic Sentiment Index, powered by HPS, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
All right, back on the Macrocast. We're going to come back and talk about. We want to talk a little bit about Europe, and which we haven't done in a long time. But first, we actually have some happenings here in DC, in a place where happenings don't happen very often. We got some movement on. The Defense Authorization Bill, the NDAA. It's usually considered a must-pass bill. We had a continuing resolution to kick spending into 2022, and we have some unique contortionist legislation to allow Democrats to raise the debt ceiling. That's happening. It's happening by the bizarre method of Congress passing a bill to create a one-time mechanism that would allow Democrats to raise the debt ceiling on a largely standalone measure, although they're putting some Medicare healthcare protection measures in there as well. But essentially to raise the debt ceiling with 51 votes and make it filibuster proof, but not having to use reconciliation. It's still crazy to me, the contortions that these guys will go through to avoid this vote. Because
what voter cares about this? I'm just amazed how worried people
are. I'm going to go back. I'm going to go do a little research this weekend and just take a look, because it's my contention that no one has ever lost an election based on their debt ceiling vote, ever, of either party, anywhere. And I don't even know that there are. People have cut ads about people who have voted to increase spending and increase the debt. I wanted to look to see if there are ads out there that have been cut that specifically talk about and point to the debt ceiling. And so it's a paper tiger, and yet these guys cower in the corner anyway. But anyway, it's going to get done. Again, another taking air out of the balloon. If we, looking a few months ago, looking at the end of the year, it looked like it was a pressure cooker. Now, what it does do, getting these things out of the way, NDAA, debt ceiling, CR, is it does clear the decks for the next couple weeks to have a little bit of Build Back Better drama. The Senate Majority Leader, Chuck Schumer, has his latest deadline is a Christmas deadline to pass Build Back Better. Most people don't believe that's doable. but they are clearing the decks to give it the college try. And so they're going to have time to do it. The Build Back Better bill is currently going through the so-called bird bath in the Senate, the BYRD bird bath, Senator Byrd's conditions for reconciliation that it deals with spending and budget items. So checking for the germaneness of elements. It's going through that process right now and will emerge maybe as early as today, but more likely, early next week. So we'll get a look at what exactly the Build Back Better reconciliation bill is, and they can take it to the floor. He intends to take it to the floor and start debate on it, which will be extensive. We'll have some big amendments, big and small, and we'll see what happens. But at least I'm not ready to make a bet on whether they can get it done by Christmas, but we are going to see that for the next couple of weeks.
Yeah, the inflation number has been playing into that, and obviously, Minority Leader McConnell came out and was banging on about today's number. But it's not just the Republican side. Senator Manchin has explicitly referenced the inflationary consequences, and I think that's something that Treasury Secretary Yellen has pushed back on. In particular, saying that these measures are designed to get people back into the workforce, particularly women and groups that are disproportionately affected. So it's a push and pull. We'll see how it comes out.
It does make you wonder, though, whether if this does get pushed into 2022, the longer this thing sits out there, it seems like the less likely that it's going to happen at all. And if you pull, it's one of the reasons why I felt like, if maybe it was too high risk for them, but to, use the debt ceiling as an impetus to, put it in the reconciliation bill. Say you don't want to put it in the reconciliation, put it in the reconciliation bill and make it something like a must-pass bill, and really grind the negotiations on it. If you have debt ceiling accounted for, and you have the budget accounted for the most part, I'm not sure what the pressure is.
There's nothing that has to be passed. Yeah.
NDAA, goes by the wayside, and then you're in an election year. And I just have to think, if it gets passed, if 2021 ends without Build Back Better passed, the chances of it actually getting done, I think, would have to go, pretty low. There's our drama. But the market, did the market really care at this time about debt ceiling? Or they just believe it's going to get done?
No, it really is you can see a minor kink in the T-bills maturing around, the debt ceiling, the sort of foggy deadline of when that event horizon would be. But that's really all it's been. And that's all it's been in like the previous episodes of this in recent memory. You can see a flicker of it in T-bills markets, whereas that, there's a little bit of higher yield on the one that's in the spotlight and aligned with that particular event. But broader markets, we've seen this movie before, and try to go into an investment committee meeting and say, I think we need to bring risk in the portfolio down because of a debt ceiling, the potential for a debt ceiling accident. Everyone would just boo you out of the room because it's assumed that an 11th hour fix will be found. So that's, as we said before, that always ironically that means it's more likely that there is an accident, the complacency in markets about it, but that's just the way it is.
It is going to be interesting because look, presumably what's going to happen. I mean, it's tough to make predictions, especially about the future, as Yogi Berra once said. But if the Senate flips to Republican control in 2023, and we've got another debt ceiling increase, and there are Republican members who are not going to vote for the debt ceiling. And it's going to be just the position that these guys are going to be in, having set the precedent that the party in control has to provide the votes for the debt ceiling. I mean, if Democrats choose to go by what is now, you have to call it the McConnell rule, that the party in control of the Senate must provide the votes. It's going to be, I can't wait to hear what the story is going to be about why these guys who wouldn't do it before are going to have to do it then. And it's,
well, why don't they raise it by $1 gajillion this time?
That's a great question. Well, if you're Democrats, and you
think you're going to lose it, you want to make them do it in 2 years.
Put Republicans in that same place. Yeah,
exactly.
So it's the bane of my existence for the past 20 years, and I don't think it's going away. So I have lots of opportunities to talk about how stupid this thing is in the years to come. All right, let's take a break, come back, and look at a little bit of the big blue marble. You're listening to the Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter at marketspolicy.
All right, back on the Macrocast. Guys, we haven't paid attention to Europe. I mean, usually like when we go sleepy on Europe for a little bit, something crazy happens over there. And I don't think there's anything crazy right now, but I definitely want to take a look over there, because we have both political and economic movement in Europe, and they seem to be behind us on things like on COVID. But John, how are you seeing the world's largest economy right now?
Yeah, it's a really important transition period for Europe, and there's just an enormous amount going on. The headliner obviously is the post-Merkel era in Germany, and what that means for the continent, what that means for the European project as a whole. And it's a pause and reflect kind of opportunity, and looking back at what she was able to accomplish and what she maybe wasn't able to accomplish. And so I guess the general consensus depends on whether you're looking at it from France, whether you're looking at it from Italy or Germany. But I think that there's a sort of broad global consensus that Angela Merkel was incredibly adept at being a uniter and moving the European project through some very rocky times. The global financial crisis, the European financial crisis, Greek debt, all this Brexit. These are really challenging and wrenching moments, and she was a stabilizing, calm presence at the center of Europe, and it was clear who was in charge, and that really meant something that was worth something in those troubled times. The knock on her has always been that she was a local politician and that she didn't have a grander vision for Europe. There was no sense of where, the European project would be, and inspiring and that sort of thing. And that just wasn't her game. And so I think that, from the view of perhaps the view of France, there's maybe a need for a little bit more grandiose leadership. And Macron is styling himself as that successor, but with a much more significant sort of pan-European vision. But he's facing some challenges at home, and it's not really clear if he's going to be able to assume that mantle. He's relatively more controversial. Our guy Draghi is another candidate, and I think we've talked before about the potential for the poles of power in Europe to be shifting south, and certainly with the European Central Bank President Christine Lagarde having a very sort of southerly friendly kind of tenure at the European Central Bank so far, and her sensibilities are quite clear on that. We'll talk a little bit more about the ECB. That may play very well into a Draghi sort of leadership, which tends to be more about freeing up sort of those fiscal constraints that Angela Merkel and the Northern Europeans have put on the bloc, and the movements toward unity, fiscal unity. We've seen some of those spring up around the pandemic. But it's at a time when certainly there's real geopolitical pressure as well, whether it's Nord Stream 2. Or whether it's the situation with Ukraine and Russia, the U.S. trying to get Europe on side on its campaign to counter China on tech and a variety of different fronts. It's a very pivotal moment, and at a time when leadership is in flux. The one thing that does seem to be pretty certain is that the European Central Bank is about as the most dovish central bank out there in the world these days. If you're still on team transitory, as we're kind of, maybe we're transitory 2.0, not fleeting, but more like not permanent. That is, you can look to the ECB to find some fellow travelers in that camp. They're still transitory.
Sure.
And we're going to see them meeting next week. They've got their decision coming up on the part of their quantitative easing program that's specifically pandemic related. That's probably going to run off next March, but it's going to be cushioned with perhaps a temporary or at least some kind of boost to the regular underlying maintenance dose, so to speak, of quantitative easing / asset purchases that they're engaged in. It's a fascinating time for Europe, but they do have unity and purpose on a variety of different fronts, and one being this newly announced Global Gateway Initiative, which is their approach, their answer to the G7 call, that the Biden-led G7 call to get out there and offer an alternative to China's Belt and Road Initiative, which has been the global. The Beijing-backed global infrastructure campaign, and the announcement from the EU was 300 billion euros, which is not chicken feed, and their ability to actually push forward some of these projects with sustainability and green kind of goals. That's whether they're able to execute on it is still a question. But if you look at infrastructure, the Europeans do infrastructure in a way that maybe we aren't able to. So I think that there's really something there.
Yeah, sure seems like it. I mean, they've that level of cooperation is somehow it's easier for them. I do agree with you on the politics are just fascinating. You don't get we have these. Every 4 years or every 8 years, where it's very clear where the center of power is and where it's changing. And that's with the White House changes control, and it's fairly easy to see. It's murky in Europe, because you have even with the EC and the EU presidency, you have a lot of decentralized power. And there are no great parallels. It'd be like wondering, well, if being governor of California had an outsized impact on the policy of the United States, it would be really fascinating. Yeah, but that's not the case at all. And it's not like California has seats on the central bank or whatever, right? It's not. It's just a very different kind of system. So you look at things like, the after 16 years, right, of the Merkel chancellorship, potential change in Macron possibly in trouble in France. We used to think about whatever happened in the UK, and we don't so much anymore. But those were the kinds of things you have to kind of figure out where the power center is, and it's definitely not obvious that it's. Germany, because of its size and importance, but it's not clear that Scholz does that.
Exactly. Yeah.
They have, you're right. So ECB has been particularly dovish. One of the thing I think about with Europe, though, is they have structural issues that make it harder to really generate strong inflation. They have not been running as hot as we have they? Have you looked at the most recent numbers?
Not as hot, but Germany's inflation was just came in this morning, and it was the highest in 30 years. It's lower than ours, but I think it's still like the headline number is still like 5%.
Yeah, and in normal times, they have a harder time generating inflation.
Oh, absolutely, yeah. They've got a disinflationary morass that looks kind of closer to Japan than ours.
Yeah. So interesting policy choices for them ahead, and just seeing how that plays out. But thanks for taking us through it, John. Guys, what do we have next week? I'm just going to be listening next week. I'm going to be off on Friday with some family things. But what do we have on the week?
So as we mentioned earlier, we have that big FOMC meeting where you've already laid out exactly what's going to happen. But we also have
no need to tune in next week. You got tomorrow's news today.
Yeah, exactly. We'll just send it to the Wall Street Journal now and be done with it. But then the ECB and the Bank of England also have important meetings, especially the Bank of England, which, as we mentioned, have been a little wishy-washy lately. And then we also it's the central banks in Japan and Mexico, and probably most interesting, Turkey, which has been a bit of a disaster lately. So we'll
disorderly. See. Yeah. It is dismal. The currency is just bleeding out.
That's what happens when the president takes over a central bank.
Well, we'll keep an eye on all of that, and I'll be interested in y'all's thoughts on that when I listen to the podcast next Saturday, probably.
Yep, and then we're going to film our year-end kind of outlooks for the new year, which is always a fun one to do.
Oh, can't wait. All right, guys.
Have a great weekend.
Good CPI day. Have a great weekend, and I'll be listening to you next week.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.